All right, fellow AMC stockholders, XMAX Trading here. I'm going to go over some important DD about Citadel and SEC lawsuit. So if you haven't subscribed to the channel just yet, go ahead and click on subscribe, help the channel out, give a like on the video and notifications, and let's get started. So Citadel fights the SEC on new D-limit order against arbitrage. Breaking news, Citadel is suing the SEC over the D-limit order that would protect displayed lit orders from being picked off by latency arbitrage players. They would protect displayed lit orders. The SEC failed. So Citadel is saying the SEC failed to properly consider the costs and burdens imposed on by this proposal that undermine the reliability of our markets and harm tens of millions of retail investors. Citadel does not care about retail investors. We all know that. You guys know what's going on. Okay, Citadel is doing this for their own business purposes. Now that this has been an ongoing battle since last year, however, new documents show that this fight has risen in court again. In fact, a new court date is set for October 25th of this month. This is big. So this is articles by Frank Nez, pretty good. Let's get started. What is the D-limit order? The D-limit order is designed to protect liquidity providers from potential adverse selection by latency arbitrage trading strategies. This rule basically gives traders a way to buy or sell stock at the exchange while protecting them from most unfavorable price moves according to Reuters. This rule gives traders a way to buy and sell stock at the exchange while protecting them from unfavorable price moves. The D-limit order is an artificial intelligence order type that protects displayed lit orders from being picked off by latency arbitrage players. It aims to benefit displayed equity market quotes with better prices, larger display size, and more competition among liquidity providers. This order is a massive threat to Citadel as it takes away predatory trading through the practices of market arbitrage. Boy, that's a lot of fancy words. What the heck is market arbitrage, guys? Well, let's talk about it. Market arbitrage is the act of buying a security in one market and simultaneously selling it in another market for a higher price. Ooh, that's sneaky there. Buying the security in one market and simultaneously selling in another market for a higher price. Traders subsequently attempt to exploit the arbitrage opportunity by buying a stock on a foreign exchange where the share price hasn't yet been adjusted to fluctuating exchange rates. This type of trading takes advantage of everyone involved, including retail investors. Damn you, Citadel, damn you. Citadel personnel argue that the D-limit is detrimental to retail, millions of retail, undermining the reliability of the markets. Bullshit. How could you even argue that point? That's insane. Market arbitrage is a form of predatory trading. The D-limit order fights against latency arbitrage from high-frequency traders such as Citadel Securities. The D-limit order will provide the markets with more accurate prices and prevent high-frequency trading firms from using arbitrage strategies to plummet or extensively short stocks. In short, Citadel has been fighting the SEC to continue using manipulative strategies against retail investors. Apes in the community will have to back up the SEC to create this massive change in our market. Citadel Securities versus SEC, October 25th, 2021, boxing match. This battle between Citadel and SEC has been occurring for quite some time now. However, Citadel and SEC have a new court hearing. The fight for fair market continues. The lawsuit fights against the use of D-limit order through the IEX exchange. That's the more fair exchange that was Brad Katsuyama. I saw it in 60 Minutes. The IEX exchange would provide the markets with a solution against arbitrage trading via AI technology. Argument. Citadel enjoys an unfair advantage over other participants. Citadel Securities has been facing major scrutiny over all over social media, has now been recognized for its multiple scandals in the public's eye. In a series of documents of the court hearing, the SEC explains how Citadel has profited billions from high-frequency trading. Argument. Citadel enjoys unfair advantages over other market participants. Today's market securities are more prone to abusive, high-frequency trading due to their fragmentation, advances in computer trading technology, and current regulations that allow firms to exploit minuscule time delays embedded in trading and quote prices. Citadel and a handful of other high-frequency trading firms spend vast sums to acquire sophisticated computer software, gain access to trading data and other market participants, and acquire data feeds that supply them with non-public information. The D-limit order wouldn't just target Citadel Securities, it's going after a handful of other HFT firms. Eliminating these manipulative strategies was extremely bullish extremely bullish for retail investors. For example, the markets wouldn't be as volatile. High-frequency trading has been the cause of several market meltdowns, so limited practice would provide retail investors with a fair playground. Citadel, as a market maker, prices more than 40% of retail trades in the market and 100% what comes from Robinhood. This means Citadel has been making money on every trade that's been processed merely from high-frequency trading. You essentially have this monster of a company making money off every opportunity they can get a hold of, even if it means cheating retail. Opposing this order is not protecting retail. Citadel is suing the SEC to continue the market manipulation, and we cannot let this happen. How will D-limit order affect the memes? D-limit order will allow momentum stocks such as AMC and GameStop to run more naturally by eliminating some manipulation that suppresses the stocks from performing better. The thing about arbitrage trading is that because these hedge funds are able to find foreign exchanges where the price hasn't yet been adjusted, they can buy current price stocks and sell short in other exchanges. The D-limit order is meant to eliminate these strategies. This market arbitrage could very well explain how hedge funds and HFT firms are able to short momentum stock despite having massive buying pressure. Massive kudos to SEC for fighting against Citadel. There's a lot of going on in the background that we usually aren't aware of. I feel that as a community, we must give our strength to regulators to make a difference in the market. This is democracy, and we want a fair market. Will the D-limit order be upheld? The D-limit will create massive change in the markets in general, not just the ape community. The order must be upheld. There's no justification why it shouldn't be. It's up to our community as engaged and active investors to make this information known. It's up to us to fully support the nature and to create real change in the markets. Our community doesn't have the full trust SC just yet. But we must support those in power who are fighting against market manipulation. And AMC and GME short squeeze depends on it. Hedge funds will not go down with a fight, so a fight it is. A fight for a fair market, a fight for the community, and a fight for your financial freedom. Moas is inevitable, but it will be up to us to ensure its fruition. Final words. Join Discord. Wow, guys. That is pretty amazing. I also want to go over this. So, bettermarkets.org, the SEC briefing. Unfair. Let's look up the word unfair. Citadel enjoys unfair advantages over other market participants. One of better markets' primary goals is to limit the structural weaknesses and inequities in our security markets. Those markets are increasingly fragmented, fragile, and unfair, as firms like Citadel and a handful of other privileged market participants enjoy clear, indefensible advantages. Using high-speed, computerized algorithms coupled with preferential data access, essentially the right to see the cards held by other players at the table, these firms generate virtually guaranteed trading profits day in and day out. Predatory strategies continually pick the pockets of countless retail investors for reasons utterly divorced from fundamental analysis of corporate value and rational capitalization. Their activities drive away retail investors from transparent exchanges, reduce liquidity and price transparency, undermine the confidence and integrity of our stocks. Argument. Citadel enjoys unfair advantage. Today's securities are prone to abusive HFT due to fragmentation, advanced computer technology, sophisticated. In addition, they pay to attract order flow from other brokers, which fuels their trading strategies. As a result, they enjoy highly profitable advantages over other market participants. Our highly fragmented market facilitates high-frequency trading strategies. When investors want to place a buy order to place an order to buy or sell, their brokers have a dizzying array of routing options. They can send orders to one of at least 16 public exchanges known as the lit exchanges, because they are the transparent and highly regulated. These exchanges display the current best and sell price for securities. They also require to send that pricing information to a data feed that is publicly available on a non-discriminatory basis. This pricing data determines we are deemed to be the current national best bid for a particular stock. Also must accept the competitor's bid and offer bid posted at any trading venue. IEX is one of those lit or transparent exchanges. Brokers can then send orders to one of the 30 alternative trading systems, ATS, darkpool. Darkpools indicated by the name are less transparent. Their prices are not publicly available, and they do not contribute to the public data feed. That informs the national best bid and offer. Darkpools are less regulated than lit exchanges, and they attract investors or traders who worry that lit exchanges and other traders, high-frequency traders, may pick off their orders at inferior prices. Finally, brokers may send orders to one of at least 7 HFTs known as internalizers, such as Citadel. HFT firms execute orders against their own inventory, internalize the orders, and they route the orders to a dark pool exchange. Internalizers show very little regulation. D-limit order type neutralizes these advantages and places all investors on equal footing with Citadel. SEC correctly approved of its use under the applicable Exchange Act Standard, a furtherance of its duty to protect investors rather than safeguard the fundamentally unfair, anti-competitive business model market participant. Conclusions. For the foregoing reason, the petition should be denied. The petition to stop the D-limit order. Wow, guys. Just wow. Amazing. Alright, guys. Thanks for staying for the whole video. Until next time, see you later.